Hi, in this video we're going to discuss part of Chapter 3 regarding the adjustments that you will have to learn. So it starts with a discussion in your textbook regarding accrual-based accounting, what that means. I will speak about those terms at the end of this video, so right now I want to discuss the accounting cycle. You learned in prior chapters part of the accounting cycle. Chapter 2, you really learned the first thing you need to know for the accounting cycle, how to record transactions, how to record debits and credits on everything that happens. You also learned in Chapter 1 the 4 financial statements. Your income statement is first, your statement of stockholders' equity is second, your third statement is the balance sheet, your fourth statement is statement of cash flows. All of those statements are for a period of time. That's really important. Except for the balance sheet, it's at any point in time. So this represents time passing. Every day, time is passing. Every business goes through this cycle at least once. Some businesses choose to do this cycle every month, some do it every quarter, and some do it just once a year. So you are going to learn that when you visualize this cycle, all of it works together. This arrow represents some period of time passing. The rest of these arrows kind of all happen at the end. So this first arrow represents at least a month, a quarter, or a year passing, depending upon what kind of transaction you are doing in your textbook or in your homework. So pay special attention to dates. Dates are really important in this chapter. This represents time passing on this first arrow. Time passes. So certain accounts, not cash, but a lot of other accounts need to be updated and adjusted. This spot in the cycle is what you're going to work on in this chapter. Certain accounts that need to be updated or adjusted would be supplies, prepaids, accrued expenses, which means those are things that happen but they haven't been paid yet. So prepaid, supplies, accrued expenses, depreciation, which is also the usage of some asset. These items, when they get used, they will need to be expensed. Depreciation is the usage of our long-term assets. And then the other two we're going to discuss would be interest and your recording of unearned revenue as earned revenue. So once you've earned the unearned, it would be adjusted. So some time has passed and these items plus any unearned revenue or deferred revenue and interest might need to be updated in our chapter. Supplies, let's talk about that really quickly. Those are an item, a short-term item, that every time I use a pencil or a piece of paper, I'm not going to make an accounting entry for. So I'm going to wait until the whole month is over, and then I am going to adjust supplies. Supplies and prepaids kind of have a little formula that you're going to work with that say those items could have a beginning balance. They are permanent accounts. We'll talk about that more in the next video. But you take your beginning balance of supplies, I'm going to write it right here. You add any purchases, and you subtract the ending. So from here, the beginning, all the way to the ending, you have to assume that some amount of time has passed. The difference between your beginning supplies balance plus your purchases minus your ending after some period of time has passed, after a whole month has gone by or a whole year, and you've gone in and you've looked to see how much you have left in your supplies, this ending number then says what is left. That amount, the difference, would be what we called our used, and that would be your expensed amount. Now, supplies expense is not the same thing as supplies. Supplies expense says here's how much we used, and then the supplies are a permanent account that say here's what's left. Every adjusting entry is going to have at least one income statement account and one balance sheet account on the entry. So I'll say that again, it's really important. Every adjusting entry has to do with at least one income statement account, which is either a revenue or expense, and one balance sheet account, which is going to be either your liabilities or your assets. So when you're calculating your supplies, you're looking at what did we have and then what is now left over after some period of time. The difference is what must have gotten used. Now, without going into an explanation of several of these adjusting entries, I'm going to say why we would want to do this. The main reason is because adjustments help to update your account balances. You need your account balances to be updated before you print any financial statements, so they'll be accurate. Also, we follow the accrual basis of accounting. The accrual basis of accounting says we will record things when they happen, even if no cash is exchanged. So an example of that would be if I provide a good or a service for a client and they don't pay me right now. If I did the work, I go ahead and record revenue because that's part of our accrual accounting system. It says we record work or revenue when it happens, even if we don't get paid with cash. We would debit our accounts receivable that says we need to receive money, and we would credit revenue, part of equity, increasing it. Also, expenses work the same way. So your trump rule is we record everything when it happens. We want it to be in the right time frame. Accounting is really focused on accurate and timely information. So we put everything in the right time frame, in the right month, the right quarter, or the right year. If I receive a utility bill in the mail, it's the end of the month, I've used the utilities, that's how I got the bill. They went and shot my meter and it said I used up XYZ amount of kilowatts of energy. I would get that bill, but maybe it's not due for another 30 days. So I would post that bill. I would debit the utilities expense since I already used it and credit my payable in the month that the utilities were used. The current month, let's say September, I would record it even though I'm not going to pay it until October. That says we're following the accrual system, which record things when they happen. It also, besides recording revenue when it happens, which is called your revenue recognition principle, it also says we want to follow the matching principle, which means there's a cause and effect relationship between revenues and expenses. You've heard that phrase, you got to spend money to make money. It's not always with cash, but you have to incur some kind of cost, some kind of expense to generate revenue. I buy supplies and I use them to bring in, to make a product or something, to bring in new clients. I have advertising expense to bring in new clients. I have people that work for me, so wages or salary expense. Those are all items that should generate revenue. So the matching principle says we're going to record related revenues and expenses in their same time frame. That's about it for this first video of the chapter. I'll do a separate video on the closing process. Thank you.